Well, it's been 10 years since the global financial crisis. It's been an unusually long period of growth, so it's probably not a surprise people are beginning to wonder, is this coming to the end of the road? To use investment terminology, people are saying that we're late in the cycle and therefore we should be worried, maybe change our investment strategy. Now our response is, things aren't that simple. The world doesn't move like clockwork in predictable patterns like that. Some parts of the economy are going well, some doing less well. Now we prefer to actually think in terms of 3 different cycles, which are related, which can influence each other, but they can be in different phases. So we're talking about the business cycle, the credit cycle, and the market cycle. Well, first, the business cycle. This is the economy. So are we creating jobs? Are wages going up? And the answer is yes, yes we are. Now, is that causing prices to go up? Is that causing inflation, which the central bank might have to raise rates to cool down? And the answer is not yet. So despite the trade war, despite all the noise we hear, the business cycle is actually doing okay so far. The second cycle, this is the dangerous one. This is the credit cycle. This is how much debt there is in the economy. And it's dangerous because when the business cycle turns, the amount of debt tells us how much trouble we get into. Now, if we look at household balance sheets, bank balance sheets, the good news is these are much safer levels than they were the last time around. So we feel okay about the credit cycle. The third one is the market cycle. Now, here's the problem. It's expensive. So even though the credit cycle and the business cycle we feel okay about, they're not overheating, the market has gone ahead of the economic reality. So even if we're right about the other 2 cycles, we won't necessarily get high returns from it because the price is already high. Now that doesn't mean you sell your portfolio, it just means it's probably not a good time to add extra risk. So what are we recommending? Well, number 1, make sure your financial plan is robust. You have enough liquidity to go through your bumps in the road. Number 2, hold on to a diversified portfolio of high quality assets. And number 3, be ready to take opportunities when they come.